In 2021, a family in Texas had full home insurance. After the historic winter storm, they received $0 in compensation because the damage was outside coverage. In 2023, after floods in Germany, tens of thousands of claims were frozen, even as premiums had risen more than 30% over a decade. Globally, the insurance industry collects over $7 trillion a year. But when disaster hits, why does the promise disappear? If insurance exists to protect you, who is it really protecting? In 2019, a 32-year-old woman in the United States finished chemotherapy. She was insured. Her policy was active. Weeks later, the bills arrived anyway. More than $90,000. The insurer rejected the claim, citing a technicality. The hospital used an out-of-network anesthesiologist she never met. Treatment saved her life. Insurance did not save her finances. This is not rare. In the U.S., insurers deny roughly 15 to 20% of initial medical claims. Some companies reject far more. In 2023, one major provider was reported to deny over one-third of all claims it processed. Appeals exist, but fewer than 1 in 500 patients successfully challenge a denial. Most give up. Time runs out. Debt does not. In France, cancer patients face growing out-of-pocket costs for non-essential drugs. In the UK, flood victims discovered their policies covered rainwater, not river overflow, even when both entered the same living room. In Japan, long-term care insurance limits support by age brackets, not medical need. Different countries. Same structure. Coverage exists until the moment it matters. Globally, insured people now carry more risk than ever. Deductibles rise. Exclusions multiply. Policies get thicker, not clearer. Insurance no longer asks whether harm happened. It asks whether harm qualifies. One word in a contract decides the outcome. If protection depends on wording you never negotiated, is that protection at all? If survival is covered but recovery is not, what exactly did you buy? And if millions share this experience every year, is this still a system failing people, or a system doing exactly what it was built to do? Insurance is everywhere, and that is the problem. Health, homes, cars, work, travel, disasters. In most developed economies, living without insurance is either illegal or financially reckless. By 2023, global insurance premiums exceeded $7 trillion a year, more than the GDP of every country except the United States and China. In the US alone, insurance spending averages $7,000 per person per year. In Germany, it is over 3,000 euros. In Japan, nearly 90% of households hold at least 3 separate insurance policies. If insurance exists to reduce uncertainty, why has daily life never felt more financially fragile? Start with disasters. Over the last decade, global economic losses from natural catastrophes averaged $270 to $300 billion annually. Yet insured losses covered only 40 to 45% of that amount. The remaining gap is carried by households, small businesses, and governments. In 2021, Hurricane Ida caused more than $75 billion in damage across the U.S., but less than $40 billion was insured. In Europe's 2023 floods, Germany alone recorded 12 billion euros in losses, while insured payouts covered roughly half. The rest did not disappear. It moved onto balance sheets that cannot absorb shocks. Now look at premiums. In the U.S., average home insurance premiums rose over 40% between 2019 and 2024. In Florida and California, some households saw increases of 100 to 300%, while others were dropped entirely. In Australia, home insurance premiums increased 20% in just 2 years, driven by flood and fire risk. In the UK, flood-prone properties now face premiums that can exceed £3,000 a year, even with government-backed reinsurance schemes. Risk is rising. Coverage is shrinking. Prices move in the opposite direction of protection. How did that become normal? Health insurance tells the same story. The United States spends more than $4.5 trillion a year on healthcare. Yet medical debt remains the leading cause of personal bankruptcy. A 2022 survey showed that over 100 million Americans carry some form of medical debt, many of them insured. In-network coverage does not guarantee payment. Deductibles, co-pays, exclusions, and pre-authorizations decide outcomes long before doctors do. In Japan, where universal coverage exists, patients still pay 10 to 30% out of pocket, and aging demographics are forcing insurers to quietly reduce reimbursement rates. If coverage expands but protection weakens, what exactly is being insured? Auto insurance offers another contradiction. Global vehicle insurance premiums exceed $900 billion annually. In many countries, it is mandatory. Yet claims denial rates have risen steadily. In India, nearly 1 in 3 claims is disputed or delayed. In the US, usage-based insurance penalizes drivers through telematics, raising premiums based on behavior data that policyholders rarely understand or control. Safer driving does not always mean lower costs. It often means more data collection. Is that protection or surveillance sold as safety? Zoom out further. Reinsurance, the insurance of insurers, concentrates risk into a small group of global players. A handful of firms now underwrite disaster exposure for entire regions. When they pull back, local insurers collapse. When local insurers collapse, coverage disappears overnight. After wildfires in California, several insurers exited the market entirely. Homes became uninsurable. Mortgages became impossible. Property values fell. A financial instrument quietly reshaped entire communities. If insurance withdraws, does the city still function? The industry explains this with math, risk models, climate projections, probability curves. And they are not wrong. Climate-related losses have tripled since the 1980s. Extreme weather events are more frequent, more intense, more expensive. But here is the paradox. The more accurate the models become, the less insurable reality gets. Precision does not create safety. It creates exclusion. When every risk is priced correctly, many people are priced out entirely. Governments step in. Public insurance pools. Disaster relief funds. Bailouts. In effect, losses are socialized after profits are privatized. The system survives, but its original promise changes. Insurance no longer guarantees protection. It guarantees a framework for deciding who is protected, under what conditions, and at what cost. If insurance is mandatory, but coverage is optional. If premiums rise faster than incomes. If disasters are certain, but payouts are conditional. Then what is the system really designed to do? And if this is not failure, but design, who does that design ultimately serve? Insurance was built for accidents, not for patterns. It works when losses are rare, isolated, and short-lived. One house burns. One car crashes. One patient gets sick. The many pay so the few can recover. That logic only holds if risk stays exceptional. The paradox begins when risk becomes normal. Look at housing. In the United States, standard home insurance excludes floods. After Hurricane Harvey in 2017, more than $125 billion in damage was recorded. Less than 30% was insured. Most homeowners had insurance. Most still lost everything. The exclusion was not hidden. It was standard. Protection existed, but only for a version of disaster that no longer reflects reality. Rain falls differently now. Storms stall. Water rises slowly, then stays. Insurance was designed for yesterday's weather. Germany shows the same pattern. After the AHR Valley floods in 2021, entire towns were destroyed. Only about 50% of homes had flood insurance. Not because people refused it, but because insurers classified many areas as low risk until they were not. Risk maps lag reality. When the model updates, coverage disappears or prices explode. The event does not break the system. It reveals what the system cannot handle. Health insurance exposes the paradox even more clearly. Acute events are easy to price. Chronic ones are not. In the United States, a heart attack is often covered. Heart disease is not. Cancer treatment may be approved. Long-term side effects, rehabilitation, lost income, and mental health support often are not. A 2022 study showed that 1 in 4 insured cancer patients still faced serious financial distress. They survived medically. They failed financially. Insurance did its job, just not the job people thought they were buying. Japan offers a different case. It has universal health coverage. But long-term care insurance is capped by age and dependency level. As the population ages, more care is needed, but reimbursement does not scale. Families absorb the gap. The system remains solvent. The burden quietly shifts. Protection exists, but only up to a line that moves downward each year. Auto insurance reveals the same structure through technology. Usage-based insurance promises fairness. Drive safely and pay less. In practice, telematics data is used to reclassify risk faster than behavior can change. Sudden braking, night driving, location patterns. Premiums rise even without accidents. In the U.S., drivers enrolled in telematics programs saw average premiums increase 8 to 15% after initial discounts expired. Data refines exclusion. It does not guarantee reward. Climate change turns this paradox into a systemic crisis. Over the past 4 decades, global weather-related losses increased more than threefold. Insured losses increased too, but far more slowly. The gap widens every year. In California, insurers stopped writing new home policies in high fire risk areas after losses exceeded expectations. Homes became uninsurable. Without insurance, mortgages became unavailable. Without mortgages, entire communities stalled. Insurance did not collapse. It withdrew. The market survived. People were filtered out. Reinsurance magnifies this effect. A small group of global reinsurers now carry disaster risk for entire regions. When they raise prices or reduce capacity, local insurers follow. After major floods in Asia and wildfires in Australia, reinsurance costs jumped 30 to 50% in a single renewal cycle. Local insurers passed those costs on or exited markets. Coverage shrank overnight. No law was broken. No fraud occurred. The system adjusted exactly as designed. This reveals the core contradiction. Insurance promises stability, but it requires instability to remain manageable. It needs disasters to be infrequent, localized, and statistically obedient. Modern risk is none of those things. Climate events overlap. Infrastructure failure compounds damage. Illness lasts longer. Supply chains amplify shocks. The math that made insurance possible now works against it. So insurers adapt. They narrow definitions. They add exclusions. They raise deductibles. They delay claims. They transfer risk to governments through public disaster funds. Losses are socialized after profits are booked. Insurance continues to exist, but its meaning changes. It no longer guarantees recovery. It guarantees a process. This is why insurance rarely says no outright. It says not yet, not this way, not under this clause. Time becomes a filter. Complexity becomes a barrier. People drop out long before the final answer arrives. The system remains calm. Individuals absorb the shock. If insurance only works when risk stays small, predictable, and contained, what happens when risk becomes permanent? If protection depends on events staying unlikely, how does the promise survive in a world where disaster is no longer the exception? And when the system protects itself first, who is left carrying the losses it was never built to hold? Insurance looks simple from the outside. You pay every month. Something bad happens. Money comes back. Inside, it is not a safety net. It is a production line. And every step of that line is designed to reduce how often it reaches the final payout. The machine starts with pricing. Before you sign anything, your risk has already been sliced into variables. Location, age, health history, credit score, driving behavior, climate zone. In Florida, 2 houses on the same street can have premiums that differ by 2 to 3 times because one sits a few meters lower on a flood map. In California, wildfire risk scores update faster than zoning laws. When the score changes, the price changes. When the price changes too much, coverage disappears. Is that protection or preemptive retreat? Next comes pooling. Millions pay in. Claims are expected, but only within a narrow corridor. Insurers model losses using historical data. The past is assumed to repeat. When it does not, the machine tightens. Deductibles rise. Coverage limits shrink. Definitions harden. In Australia, after repeated floods, Insurers reclassified large areas as high risk, pushing deductibles so high that filing a claim became irrational. The policy still existed. The payout pathway did not. Then comes reinsurance. Insurers insure themselves. A handful of global reinsurers now sit above entire national markets. When they raise rates, everyone below follows. After the 2021 to 2022 disaster cycle, reinsurance prices jumped 30 to 50% in some regions. Local insurers passed costs on or exited entirely. This is how a storm in one country reshapes housing markets in another. The machine is global. The consequences are local. Claims processing is where the machine becomes visible. This is not about saying no. It is about slowing yes. Every claim is converted into categories. Covered, partially covered, excluded, pending. Requests for documentation multiply. Photos, receipts, proof of cause. In Germany after the AHR floods, some households submitted the same documents 3 or 4 times as files were transferred between adjusters. Time drains energy. Energy drains persistence. Many claims die quietly. Language is the sharpest tool in the system. The same damage can be rainwater, groundwater, storm surge, or sewer backup. Each word points to a different outcome. In the UK, flood policies often distinguish between river flooding and surface water. In practice, floods do not respect definitions. In contracts, definitions decide everything. When water enters a home from multiple sources, which one counts? And who gets to decide? Health insurance runs the same machine with different labels. Pre-authorization, medical necessity, in-network, out-of-network. A procedure can be approved in theory and denied in execution. In the US, insurers use automated systems to flag claims for review. One investigation found algorithms rejecting claims in seconds, faster than a human could read the file. Appeals exist, but they take months. Treatment timelines do not wait. If care is delayed long enough, the claim resolves itself. Auto insurance adds surveillance to the machine. Telematics devices collect data continuously. Speed, braking, time of day, routes. Insurers say this improves fairness. In practice, it creates moving goalposts. A driver can reduce mileage and still see premiums rise due to risk exposure patterns. Data does not just measure behavior, it redefines it. When the definition changes, the outcome follows. Who controls that definition? The machine also depends on outsourcing. Adjusters are contracted. Call centers are external. Algorithms are licensed. Responsibility is fragmented. When something goes wrong, no single part owns the outcome. Each step points to another. This diffusion is not accidental. It stabilizes the system by preventing accountability from concentrating anywhere. When losses exceed tolerance, governments enter the picture. Public insurance pools, disaster relief funds, emergency aid. After major catastrophes, public money covers what private insurance will not. In effect, profits remain private. Losses become public. The industry calls this partnership. Taxpayers call it inevitability. Is this a backup plan or the real plan? None of this requires malice. The machine does not hate its customers. It does not need to. It follows incentives. Minimize volatility. Preserve capital. Maintain ratings. If paying fewer claims stabilizes the balance sheet, that is what the machine will do. The language of care exists at the edges. The logic of finance sits at the core. This is why insurance rarely collapses outright. It adapts. It narrows. It withdraws selectively. Markets stay calm. Households absorb shocks. Communities change shape. People move. Or they stay and take on more risk. The system remains intact because it is designed to shed load before it breaks. If insurance is a machine that runs on delay, definition, and exclusion, where exactly does protection fit? If every step optimizes for survival of the system, not recovery of the person, what is the product really selling? And when the machine keeps running smoothly while lives destabilize around it, who is the system actually built to protect? The consequences of insurance do not appear all at once. They spread across maps, slowly, unevenly, following money, risk scores, and withdrawal notices. What looks like a personal problem in one place becomes a structural shift in another. The system does not collapse. It redraws geography. Start with the United States. After repeated hurricanes, floods, and wildfires, insurance retreat has become visible at the neighborhood level. In Florida, average home insurance premiums more than tripled between 2015 and 2024. In some coastal counties, annual premiums now exceed $10,000 for modest homes. Many insurers stopped writing new policies altogether. Without insurance, mortgages cannot be issued. Without mortgages, homes cannot be sold. Property values flatten, then fall. The risk did not disappear. It concentrated. The people left behind are older, poorer, and less mobile. Insurance quietly sorted who could stay and who had to leave. California shows the same pattern through fire. After a series of megafires, major insurers paused or exited entire regions. By 2023, more than 1 million households lived in areas where private wildfire insurance was unavailable or unaffordable. The state created a public insurer of last resort. Coverage existed, but at higher cost and lower limits. Residents paid more for less protection. The map did not burn evenly. High-income neighborhoods absorbed the cost. Lower-income areas hollowed out. Insurance became a zoning tool. Now move to Europe. In Germany, the AHR Valley floods exposed a different failure. Many homes were classified as low risk before the disaster. Afterward, insurers updated maps. Premiums rose sharply. Coverage terms changed. Some homes became effectively uninsurable. Reconstruction was possible only through public funds. The lesson traveled faster than the water. In flood-prone regions across Europe, new construction slowed. Existing residents stayed, but investment stopped. Insurance did not rebuild towns. It decided where rebuilding made financial sense. The United Kingdom adds another layer. Flood Re, a government-backed reinsurance scheme, was designed to keep flood insurance affordable. It worked partially. Premiums stabilized for existing homes. But new properties were excluded. Builders avoided flood-prone land. Buyers hesitated. Entire development plans were rewritten. Risk maps influenced urban growth more than planning committees. Insurance did not just price risk. It shaped the future layout of cities. In Asia, the consequences look different but follow the same logic. In India, flood and crop insurance penetration remains low, even as extreme weather intensifies. When floods destroy homes or drought wipes out harvests, payouts arrive late or not at all. Farmers rely on informal debt to survive. That debt traps them. Regions with repeated losses see rising migration. Villages thin out. Cities absorb the displaced. Insurance gaps accelerate urban pressure. The system does not protect livelihoods. It shifts populations. Japan's aging society reveals a quieter consequence. Long-term care insurance covers only part of the cost. As needs grow, families pay more out of pocket. Women leave the workforce to provide care. Household income falls. Consumption drops. Entire local economies slow down. Insurance remains solvent. Communities age faster. The burden moves from institutions to homes, from balance sheets to unpaid labor. Australia shows how climate risk and insurance interact with speed. After back-to-back floods, insurers raised premiums by 20 to 30% in high-risk zones within 2 years. Some households dropped coverage entirely. Others accepted higher deductibles. When the next flood came, recovery stalled. Small businesses closed permanently. Main streets emptied. Insurance did not fail. It priced reality faster than people could adapt. Even where insurance pays, the consequences persist. After major disasters, claims take months or years to resolve. During that time, households draw down savings, take loans, or sell assets. Debt rises. Credit scores fall. Future insurance becomes more expensive. The next shock hits harder. This feedback loop is rarely discussed. Insurance does not just respond to risk. It amplifies vulnerability over time. Public finances absorb what private insurance will not. Governments fund rebuilding, healthcare, and emergency aid. Debt increases. Taxes rise or services shrink. Losses are socialized. Profits remain private. This is not a temporary fix. It is now the default model. Insurance sets the boundary of responsibility. Everything outside that boundary becomes a public problem. The map keeps changing. Coastal areas thin out. Fire zones depopulate. Floodplains stagnate. Care deserts expand. Risk migrates toward those least able to escape it. Insurance does not create inequality. It formalizes it. It makes exclusion legible, contractual, and defensible. What emerges is not a single collapse, but a slow sorting. Places where insurance flows attract capital. Places where it retreats lose it. People follow coverage, not opportunity. Safety becomes a privilege tied to geography, income, and timing. Those who arrive too late pay more. Those who cannot move pay forever. If insurance redraws maps by deciding which places are worth protecting, what happens to the people who live outside those lines? If recovery depends not on damage, but on insurability, how does a society decide which losses matter? And when entire regions become too risky to price, who takes responsibility for the lives still lived there? In September 2022, Hurricane Ian hit Florida. Winds collapsed roofs. Storm surge swallowed neighborhoods. The total damage exceeded $110 billion, making it one of the costliest disasters in U.S. history. Insurance was everywhere in the marketing. In reality, it fractured on impact. Within months, more than a dozen insurers became insolvent or withdrew, leaving hundreds of thousands of claims in limbo. Some homeowners waited over a year for partial payouts. Others received denial letters citing roof age, maintenance clauses, or wind versus water distinctions. Same house, same storm, different outcome. One family in Lee County paid nearly $9,000 a year in premiums. After the storm, their claim was approved for $38,000. Repair estimates came back at $120,000. The gap was theirs to carry. They appealed. The insurer requested more documentation, photos, engineer reports, additional inspections. Months passed. The house sat exposed. Mold spread. The approved amount did not change. Insurance worked. Recovery did not. Across the Atlantic, a different disaster revealed the same structure. In July 2021, floods devastated Western Germany. Entire towns were erased in hours. More than 180 people died. Economic losses reached 40 billion euros. Insurance covered roughly half. Many policies existed. Many still failed. Claims were delayed by cause of damage disputes. Was it flash flooding? Was it river overflow? Was it groundwater saturation? Each classification carried different obligations. For thousands of households, the answer arrived too late to matter. Temporary housing became semi-permanent. Reconstruction slowed. The system processed files while lives stalled. Australia offers a third case. In 2022, record floods hit New South Wales and Queensland. Repeated events overwhelmed insurers. Some households filed claims 3 times in 1 year. Payouts arrived slower each time. Premiums rose over 30% in flood-prone zones within 2 renewal cycles. Some insurers offered renewal only with deductibles exceeding $50,000. Coverage technically existed. Filing a claim no longer made sense. After the next flood, small towns lost grocery stores, clinics, and local employers. Insurance did not deny the event. It priced people out of recovery. Health insurance produces a quieter climax, but no less destructive. In the United States, a 2023 investigation found that a major insurer used an automated system to deny post-acute care claims with a 90% error rate. Patients recovering from strokes and surgeries were cut off days early. Appeals succeeded eventually, but often after care had already been interrupted. The insurer paid fines. The algorithm remained. For patients, the damage was irreversible. Insurance followed procedure. Health followed consequences. In the UK, flood victims faced another variation. After storms in 2020 and 2021, thousands discovered their policies covered structural damage but not loss of use. Repairs took months. Temporary housing costs accumulated. Savings evaporated. Some returned to unsafe homes. Others left entirely. Insurance fulfilled the letter of the contract. The lived outcome was displacement. Reinsurance turns these individual climaxes into systemic ones. After the global disaster cycle of 2021 to 2023, reinsurance prices jumped 30 to 50% across regions. Primary insurers responded immediately. Premiums rose. Coverage limits fell. Entire categories of risk became non-core. In practical terms, that meant fewer payouts, higher thresholds, and longer delays. The financial markets stabilized. Households absorbed the volatility. Even where governments step in, the climax continues. After disasters, public funds cover gaps left by insurance. In the U.S., federal disaster aid often arrives faster than private payouts. But aid is capped, conditional, and temporary. It does not replace lost equity. It does not restore insurability. Once a home is flagged as high risk, future coverage becomes expensive or impossible. The first disaster hurts. The second one breaks the model entirely. What ties these cases together is not failure. It is consistency. Insurance performs best when events fit models. It struggles when reality exceeds them. When losses spike, the system does not collapse outward. It contracts inward. Claims slow. Definitions narrow. Prices rise. The visible climax is human. The invisible resolution is financial. People experience the peak as betrayal. Insurers experience it as adjustment. One side loses homes, health, stability. The other side preserves capital ratios and credit ratings. Both are acting rationally within their roles. The conflict is structural, not moral. This is the moment where the promise of insurance meets its limit. Not in theory, but in time. Not on paper, but in weeks, months, and years of waiting. When enough people hit that wall at once, the system reveals what it was designed to protect first. If every major disaster now produces the same outcome, partial payouts, delayed recovery, rising premiums, what happens when these events become annual instead of rare? If insurance survives by retreating after each shock, how many shocks can communities endure before protection disappears entirely? Collapse does not arrive as a single moment. It unfolds quietly, contract by contract, renewal by renewal. No announcement is made. No system officially fails. Life simply becomes harder to insure, harder to rebuild, harder to afford. What collapses is not insurance itself, but the assumption that it will be there when reality no longer fits the model. Start with housing. In high-risk regions, insurance retreat turns physical damage into permanent loss. After repeated disasters, homes that were once assets become liabilities. In parts of Florida, California, and Australia, properties lose value not because they are destroyed, but because they are uninsurable. Buyers disappear. Banks refuse mortgages. Owners cannot sell. Equity evaporates. A house still stands, but it no longer functions as wealth. Insurance does not burn it down. It removes its future. Infrastructure follows the same path. When insurance costs rise for utilities, transport hubs, and public buildings, maintenance is deferred. Premiums compete with repairs. Deductibles compete with upgrades. Flood barriers remain incomplete. Power lines stay exposed. Drainage systems age. Each missed investment increases future risk, which pushes insurance costs even higher. The cycle feeds itself. Systems designed to stabilize cities quietly accelerate their decay. Healthcare collapses differently. Coverage still exists, but care fragments. Hospitals absorb unpaid bills. Patients delay treatment. Preventive care becomes optional. In countries without universal coverage, medical debt accumulates. In countries with it, rationing intensifies. Waiting lists grow. Outcomes worsen. Insurance remains solvent because access shrinks. Survival becomes conditional on timing, employment status, and geography. Health does not collapse all at once. It thins out. Labor markets feel the pressure next. When insurance tied to employment becomes more expensive, companies reduce coverage or shift costs to workers. Deductibles rise. Benefits narrow. Gig and contract workers are left exposed. After disasters, displaced workers lose both jobs and coverage at the same time. Recovery slows. Productivity drops. Entire regions struggle to attract labor. Insurance no longer supports economic stability. It mirrors instability back into the system. Governments step in, but only partially. Disaster relief fills gaps after the fact, not before. Public insurance pools absorb the riskiest cases, often at higher cost and lower coverage. Debt increases. Budgets stretch. Taxpayers subsidize what private markets reject. This is framed as emergency response. In practice, it becomes permanent. The state becomes the insurer of last resort for risks that are no longer profitable. Social trust erodes alongside financial protection. When people pay for years and receive little when it matters, confidence breaks. Compliance weakens. Some drop coverage entirely. Others underinsure. The next disaster hits harder. Communities fragment between those who can still afford protection and those who cannot. Risk becomes stratified. Safety becomes visible. Inequality stops being abstract. It appears on maps, in premiums, in recovery times. The collapse is uneven. Wealthier households adapt. They relocate. They self-insure. They absorb higher deductibles. Poorer households stay. They rebuild repeatedly with less support each time. Over years, this creates zones of chronic vulnerability. Insurance does not cause these zones. It codifies them. It draws boundaries around acceptable loss. Climate change turns this slow collapse into a baseline condition. As extreme events become more frequent, insurance cycles shorten. Premiums adjust faster. Withdrawals happen sooner. What once took decades now happens in years. The buffer disappears. Communities do not have time to recover between shocks. The concept of returning to normal loses meaning. At this stage, insurance still exists. Contracts are signed. Premiums are paid. Claims are processed. The machine keeps running. But its role has changed. It no longer spreads risk across society. Concentrates it. It no longer promises recovery. It manages exposure. It no longer answers the question, can we rebuild? But, who is still eligible to try? This is the quiet collapse. No headlines announce it. No single failure triggers reform. The system adapts too well to break loudly. Instead, it reshapes life around its limits. Where people live, how they work, what they can afford to lose. Insurance survives by shedding obligations faster than risk grows. When protection becomes conditional on insurability, and insurability becomes rare, the social contract weakens. People are told to prepare, adapt, relocate. Responsibility shifts downward. Risk becomes personal. Loss becomes normalized. The idea that collective systems exist to absorb shock fades. If insurance no longer guarantees recovery, but only defines eligibility, what replaces it as the foundation of stability? If collapse happens quietly, without a crash, how long before society realizes that protection did not fail? It simply moved out of reach. And when the system finally reaches the point where retreat is no longer possible, who will be left standing inside the lines it drew? Go back to the beginning. The contract, the premium, the promise that if something goes wrong, you will not face it alone. That promise still exists on paper. It still appears in ads. It still sounds reasonable. What changed is the world it was written for. Insurance was built for a time when disasters were rare, health problems were short, and cities grew within predictable boundaries. That world is gone. Risk now overlaps. Floods follow heat. Fires follow drought. Illness lasts longer. Infrastructure fails together. The system did not break. It adjusted. And in adjusting, it quietly changed what protection means. Today, insurance does not ask how much damage was done. It asks whether the damage fits a category. It does not ask how badly someone needs help. It asks whether help is still affordable. Coverage exists, but only inside narrowing lines drawn by models, maps, and clauses you never negotiated. Outside those lines, life continues. It is just no longer protected. This is why the collapse feels invisible. Premiums rise before disasters hit. Coverage shrinks before losses are counted. People adapt individually. They move. They borrow. They underinsure. They accept more risk without realizing it. Nothing dramatic happens at once. The system remains calm. Stability erodes quietly. Governments fill the gaps when they must. Public funds rebuild what private insurance will not. But those funds are limited, delayed, and political. They are not a replacement. They are a signal. A sign that risk has outgrown the structures designed to absorb it. The safety net did not tear. It was slowly lifted higher. Insurance still plays a role. It just no longer carries the meaning people assign to it. It protects balance sheets better than lives. It stabilizes markets faster than communities. It survives by narrowing responsibility, not by expanding care. This is not corruption. It is logic. The logic of a system built to function under limits, now facing a world without them. For most people, the realization comes late. After the storm. After the diagnosis. After the denial letter. That is when the question changes. Not am I insured, but am I insurable? Not will I recover, but am I still eligible to try? This is the quiet end of the promise. Not with collapse, but with distance. Protection still exists, but it moves further away each year, just out of reach of more people, in more places, under more conditions. The system does not fail loudly enough to demand reform. It works well enough to persist. So the final question is not whether insurance will survive. It already has. The question is simpler and harder. In a world where risk is constant and shared, should protection still be conditional? And if the system designed to absorb loss now exists mainly to decide who must carry it alone, what does that say about the future we are insuring for?